The rich aren't playing the same game you are. They're not just working harder or getting luckier. Something else is going on, and once you see it, you can't unsee it. Most people are told that success is about effort, work hard, save, be patient. But the gap between the wealthy and everyone else keeps widening anyway. So either millions of people are doing it wrong or the story we've been told is incomplete. This video is about what's actually driving that gap, the mechanics, the rules, and the mindset, and what it means for you. We need to clear something up first. When we say the rich get richer, we're not talking about morality. We're talking about structure. How does wealth actually behave? Who does it flow toward, and why? The standard story goes like this. Work hard, get a good job, save a percentage of your income, invest in the market, and over time you'll build wealth. That story isn't wrong, it's just incomplete. It describes one path, but there are other paths, paths where the returns aren't linear. Where a single decision or a single asset can multiply in ways that a salary never will. The rich aren't necessarily working harder, they're often just in a different kind of game, one where the rules reward ownership and scale. Think about it. When you work for a salary, you're trading time for money. There's a ceiling. When you own assets, equity, real estate, intellectual property, those assets can grow while you sleep. The first group is bounded by hours. The second isn't. That's not luck. That's structure. So the real question isn't, are the rich lucky? It's, what are the actual mechanisms that make wealth concentrate? And that question has clear answers. The first mechanism is compounding, but not just in the way you've heard. Yes, money earns returns, but so does information, so do relationships, so does position. Wealthy individuals and families don't just have more capital, they have earlier access to deals, to information, and to other people who have capital. A startup raising money might take checks from angel investors before the public ever hears about it. Real estate deals, private equity, venture funds, much of this happens in closed loops. By the time an opportunity is visible to the average person, the biggest gains have often already been captured. Again, not luck. Access. The second mechanism is leverage. If you have capital, you can borrow against it at low rates and deploy that capital into more assets. If you don't have capital, you borrow at higher rates for consumption, cars, education, daily life. One group uses debt to amplify returns. The other uses debt to survive. The system is the same. The position in it is not. And the third mechanism is time horizon. If you need your money next month to pay rent, you can't afford volatility, you can't wait 10 years, so you're pushed into safer, lower return options. If you have a buffer, years of runway, you can take on risk, absorb downturns, and hold assets through cycles. Over decades, that difference in time horizon produces a staggering gap in outcomes. Not because one person is smarter, because one person could afford to play the long game. So we have compounding of capital and access, leverage that amplifies advantage, and time horizons that let the wealthy absorb risk. Put those together and you get a system that naturally concentrates wealth even without anyone cheating. The game is designed that way. But it doesn't stop there. The rules of the game, tax policy, monetary policy, regulation are not neutral. They're written by people and they tend to favor those who already hold assets. Consider interest rates. When central banks lower rates to stimulate the economy, one of the main effects is that asset prices go up. Stocks, real estate, bonds, if you own those assets, you get richer. If you don't, you might get a slightly better mortgage or a slightly cheaper loan, but you're not sitting on a portfolio that's doubling. So monetary policy, often justified as helping the economy, disproportionately benefits asset holders. That's not a conspiracy, it's how the mechanism works, or consider tax structure. In many countries, income from labor is taxed at higher rates than income from capital gains. You work 40 hours, you pay one rate. You hold stock for a year and sell it, you pay another. So the way you make money changes how much of it you keep. Again, that favors those who can afford to hold assets and live off gains rather than wages. The rules aren't random. They reflect who had a seat at the table when the rules were written. This isn't about blaming anyone, it's about seeing the board clearly. If you want to understand why the rich get richer, you have to look at policy, not just behavior. The game has a tilt. Recognizing that is the first step to deciding how you want to play. There's one more layer, mindset, and it matters more than most people admit. People who build significant wealth tend to think in terms of ownership and systems. What can I own that generates value? What system can I plug into that scales? People who stay dependent on a paycheck tend to think in terms of income. How can I earn more? How can I get a raise? Both are rational, but the first question leads to building assets. The second leads to optimizing labor. Over a lifetime, that difference in framing produces completely different outcomes. The wealthy also tend to have a different relationship to risk and loss. If you've never had a buffer, losing money isn't just a setback, it's existential. So you avoid risk, you keep cash, you don't invest in things that could go to zero. That's rational self-preservation. But it also means you never get the upside of asymmetric bets. The person who can afford to lose, who has already secured the basics, can take calculated risks. They can invest in a startup, buy real estate in a downturn, hold through volatility. So risk tolerance isn't just personality, it's position, and position is built by the very mechanisms we've been describing. None of this is moral judgment, it's pattern recognition. The rich get richer in part because they're playing a different game, with different rules from a different starting position and with a mindset oriented toward ownership and the long term. You can't copy their bank account overnight, but you can start shifting how you think and where you stand. So what does this mean for you? If the game is tilted, is the only move to opt out? No. The move is to see the game clearly and then make deliberate choices. First, shift from pure income thinking to asset thinking. However small, start a side project, a small investment, a skill that could become a product. Ask what you can own or build that might compound. Not everything will, but if you never ask the question, the answer is always zero. Second, reduce high-cost debt and build a buffer. The single biggest thing that keeps people from playing the long game is having no runway. Every dollar that goes to interest on consumer debt is a dollar that can't compound. So getting out of expensive debt and building even a small reserve changes your time horizon. Suddenly you can afford to wait, to hold, to take a calculated risk. Third, get closer to the mechanisms. That might mean learning how markets work, how companies are valued, how deals get done. It might mean building relationships with people who operate in those spaces. It doesn't mean you need to become a financier. It means you stop treating wealth as a black box and start understanding the plumbing. Knowledge doesn't guarantee success, but ignorance guarantees you'll stay where you are. And fourth, accept that the game is long. The rich get richer in part because they've been playing for decades. You're not going to reverse a lifetime of structure in a year, but you can change the trajectory. Start where you are, move toward ownership, buffer, and knowledge. Here's the bigger picture. The system isn't random. It's designed, not in a single room by a single group, but by decades of policy, convention, and incentive. And once you see that, you have a choice. You can resent it, you can ignore it, or you can learn it and play with your eyes open. The rich get richer because capital compounds, because the rules favor assets, because access and leverage and time horizon multiply advantage, and because mindset and position reinforce each other. That's not luck. That's structure. And structure can be understood. It can even be used not to become someone else, but to make better decisions from where you stand, to stop waiting for a break and start building a position. So why do the rich get richer? Because they're in a game where the rules, the mechanics, and the mindset all push in the same direction. You don't have to accept that as fate. You don't have to pretend it's fair. But if you want to change your outcome, you have to see the game for what it is. Not luck, not magic system. The next step is yours. If you want to understand how money and power really move and how to navigate that landscape, subscribe. More of this is coming. And the system isn't going to explain itself.